welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. Today, I'm interviewing Daniel Koller. Daniel is head of compliance at 1291 Group, a private wealth solutions firm located in Europe that helps clients internationally mitigate taxes, protect their assets, along with other custom-tailored wealth solutions. Our main topic of discussion today is private placement life insurance. What is private placement life insurance? Who is it usually a good fit for? And how does private placement life insurance work? Daniel Koller, welcome to our podcast.
Many thanks. Nice to talk to you.
Yeah, glad to have you. And I'm looking forward to speaking on a subject that I've been interested in for a while. It's private placement life insurance. I'm really excited to jump into that subject because I've been really curious about it. Before we talk about private placement life insurance, can you tell us more about who you are and your professional environment?
Yes, happy to do so. Thanks a lot. So my name is Daniel Koller. I was born in England. A few weeks after my birth, with my parents, we turned to Switzerland, and I grew up in the German-speaking part of Switzerland. I did my studies in the French-speaking part of Switzerland, and actually then added a doctorate in internet law to my legal background. Therefore, I have a legal infrastructure knowledge. I'm happily married with a lovely wife, have two very gorgeous kiddies, two little ladies, and have been in the financial industry for roughly 20 years now. Part-time, I work for an asset manager called WHVP, where we are actually a US registered investment advisor with a full US license and have been there for many years as a chief compliance officer. Mainly, I work with an insurance broker, and they're actually the topic of this podcast kicks in. I've been working for this insurance broker for many years now, whereas we started quite small. We grew in Switzerland. We have offices also in Geneva and Zurich in Switzerland. We then opened up an office in Liechtenstein for the European clients, and then actually moved on to the Asian world, where we also are fully licensed in Hong Kong, in Dubai, and very lately we have a local license in Dubai. So therefore, further to Hong Kong and Singapore in Asia, we are settled in Dubai with our local license. And I'm very happy to bring closer certain topics of this very, very passionate domain of PPLI.
Thanks for sharing all of that. And do you mind just jumping right into it? Look, PLI stands for Private Placement Life Insurance. So what is PPLI?
So it's possible that a lot of you have never heard about PPLI. What is it all about? So we're talking about a niche product of life insurance contracts, whereas we have a typical setup of clients investing into a policy with a certain asset strategy and having a segregated bank account behind it, whereas typically we have a floating performance, whereas performance goes up and down and losses are bared by the client. And typically what is gained is, let's say, positive performance, and this is actually to the full advantage or to the full benefit of the client. We will certainly go into details later, but PPLI, please bear in mind that it is a niche domain of insurance contracts, whereas many countries know this type of setup. And as I said, we will be able to share thoughts on that at a later stage.
Got it. And by niche, it's more like like a custom design policy. It's not so much of an over-the-counter product that's readily available. Is that right?
Yes, exactly. Absolutely. So we're not talking about retail business. We're actually talking about tailor-measured life insurance product, which is actually meant for wealthy clients, whereas we will have to take into consideration that there are costs related to this policy, and there are also benefits that obviously makes it interesting. but it is not the typical product for any type of animal, but it is really a tailor-measured, structured product for certain clients from various jurisdictions.
And which parties are involved in setting up PPLI?
Now, I would like to divide between external parties and internal parties within the insurance policy setup. So from an external point of view, we are caring with insurance carriers, we have asset managers which are involved, and we have a custodian bank with a depository account, whereas actually the asset manager executes the asset strategy of the final client. Within the policy, internally, the counterparty of the insurer is actually the so-called policyholder. He is the contractual party of the insurance company and is very usually the client himself. Now, further to the policyholder as the main person within the structure, we also have a warm body, which is life insured, which is actually needed as we're talking about life insurance policy. It's like a car insurance. You need a car to insure. We are talking about life insurances, so there are one or more life insured within the policy. Then a very typical setup or a very important party is the so-called beneficial owner. That is actually where does the money come from and who pays it in to the policy, which is then the premium payer. This is actually the setup, a typical setup of a PPLI, and on the way out, who is the recipient of the insurance benefits? We call him technically a beneficiary. So the person receiving the outflow of the money out of the insurer is called the beneficiary. There can be one or more. There can also be individuals or structures. There is no necessity to be the client himself. He can make, for instance, his kids benefit from the life insurance policy, or any other third party, which typically makes, let's say, a reasonable sense. It could be a business partner or somebody else within this setup.
And who is it typically a good fit for?
So as we mentioned beforehand, PPLI, we know the expression from private banking. This is actually the corresponding, let's say, the private insurance setup. So typically spoken, we are confronted with costs. We have bank costs, we have insurance costs, the broker has to be paid, and so on. So it does not make sense for any retail client coming around the corner. So we are talking about wealthy clients. We are talking about clients who have a professional environment, who are, for instance, optimizing their situation. We can talk about entrepreneurs or internationally, let's say, successful business people, having, let's say, inherited some wealth or whatsoever, very often needs a wealth planning and the structuring of the wealth behind it. Especially, and we will then jump into that a bit later, is that it is, let's say, a highly recognized instrument around the world. If you talk about insurances, everybody knows what you're talking about. So it is different to, let's say, trusts or foundation or offshore companies or other, where we need some, let's say, extra explanation. A life insurance company and the product as such is very well known around the world.
That makes sense. And I think like wealthy, right? It can mean like different to different people. In terms of like US dollars, how much would you just say, like, I guess like the minimum a client could be worth, net worth, to be, I guess, a good fit for PPLI?
Absolutely. Yeah, very good question. So we always have to take into consideration that the product as such has to make sense on the long run. So we are actually obliged also to give professional advice to clients, and we have to take into consideration that the starting point of the product means investing and executing an asset strategy, which, for instance, the client can define. So we have costs that kick in, and we then, on the other hand, want to achieve a net performance that is higher than the costs involved. Mm-hmm. And this is typically then from a stage where, let's say, talking US dollar, I would say $500,000 or more. Mm-hmm. And very often then there is a calculation undertaken, whereas at the end of the day, we actually do a calculation of net performance after costs, after tax. So this actually leaves the client with a certain summary result of his investments going into the policy and realizing a net profit on it. So if, for instance, you would invest $10,000 mm-hmm. the costs would be too high and it would eat up your investment within a few months, mm-hmm. and this would not be a reliable investment. And with other words, this is typically the area where this type of structuring is not ideal.
It sounds like there's a lot of strategy that goes into this, and it's like you mentioned, a niche product, which brings me to my next question. On your website, there's an acronym for PATEC. Do you mind sharing with us what this acronym means and break down each part of it?
Yes, sure. So PATEC is actually a short form where we invented these few, let's say, put-togethers. Mm-hmm. As each letter stands actually for a typical setup within this insurance product. So if I may start with P, like privacy. So in a typical setup of a life insurance policy, you have a client which is the owner of the underlying, which is typically the account holder, which is the beneficial owner of the mm-hmm. assets. As soon as he invests the assets into a policy, the insurance company becomes the legal owner of the assets, of the cash that is transferred to the insurance company. So as I said beforehand, every single policy is segregated, meaning we're talking about a segregated bank account, and the investments coming in from the client go on the bank account of the insurance company, in the name of the insurance company, in the ownership of the insurance company, and being the insurer as a beneficial owner. So we have a change of ownership at that moment, which allows especially wealthy clients who are looking for privacy to step back on their name, on, let's say, spreading whatever is, let's say, liaised to the name. And mm-hmm. we are talking about a person investing into a structure, whereas in the outcome, we have the insurance company as the owner of the assets. So this stands for P, privacy. The client gains privacy while investing into an insurance company, whereas the insurer is the legal owner of the setup. The client himself has a contractual, let's say, relationship with the insurance company where he can surrender the money out of the policy at any time as he wishes. But at this stage, we can, but we do not have to take into consideration this setup. So privacy clearly stands for this possibility to have in the, let's say, outside effect the insurance company. Mm-hmm. Then we pass on to A. A stands for asset protection. As I said, we're talking about a ring-fenced, segregated bank account per client, which helps in case of bankruptcy. Mm-hmm. So the client is protected if, for instance, insurance company should go into a situation of liquidation, bankruptcy whatsoever, or the bank, or the client himself. So we have a cell that is fully segregated and ring-fenced, and therefore actually purely, let's say, individualized and related to the client, which helps if you, to give you another example, you have a big pot of money and everybody pays $1 into the big pot, you would not know which is your $1 in this big pot.
Yeah.
Whereas if you have one bank account, this is related to you with an individual number, and the investment in the bank account, it is clearly related to you as an investor.
Mm-hmm.
So this is for wealthy people a very important element, to have asset protection right from the beginning in order to protect people from, let's say, future, one never knows, downsides of the financial markets. Then one of the most important points is T. T stands for tax, or tax optimization. So the structure we are talking about, PPLI, is a tax deferred structuring, whereas very often, according to applicable local law, we do not have taxation on capital gains. We have an investment into a structure, and then actually already set up for the next generation. We have a, let's say, tax-free growth within the duration of the policy, and many jurisdictions foresee a tax discount or even no taxation at all in the case where the warm body, as I said beforehand, the life-insured person steps away and there's a payout out of the insurance policy. So tax optimization is one of the key triggers. And just to be very transparent, we're not talking about hiding money. We're not talking about tax evasion. We're not talking about a very clever setup. We are talking about legal provisions according to local law, which then actually motivates people, for instance, for their retirement, to put money into a safe structure in order to benefit with the tax-free growth at the moment of retirement in a very beneficial manner, to take out money and having achieved a net performance which allows them to, let's say, go easily into retirement. So this is a very important point. Many of the entrepreneurs, many of international business people and so on, they are very keen on having, let's say, an efficient wealth planning that helps them having a fully compliant product, but also from a tax perspective, to help growth be able to be realized within PPLA structure. Then the next element is estate planning. Here we very often talk about next generation. So wealthy clients, especially very, very, very wealthy clients, they are already thinking about passing on, let's say, the company shares or their wealth or whatsoever to the next generation. So the challenge is actually to really structure it in a way that, for instance, probate is one of these elements that in several jurisdictions can actually take up to a few years in order to the heirs to get access to the funds. And here we have a very efficient way to structure it for the next generation and be very efficient on the payout out of the set up PPLI structure. And last but not least, C stands for cash or for liquidity. So having investments in the policy allows also at every moment that the clients may, for instance, generate a partial surrender, take cash liquidity out of the policy, and therefore care about other investments, buy a house, real estate, whatsoever. So it is actually a bit similar to a bank account where you have access to the cash within your investment structure in the policy.
Got it. Makes sense. Okay. So it kind of covers pretty much all the areas of somebody's financial plan or portfolio plan. The taxes being probably the most important, the estate plan, the liquidity, the asset protection, the privacy. It makes sense. I have a question about liquidity and taxes. So for example, if somebody has their policy, right, and they've allocated the assets inside the policy, and let's just say those assets are worth approximately $1 million US, and they need liquidity now. They want to access that money, and they don't want to liquidate. They don't want to take cash out. Rather, they want to borrow against the policy or against the assets, would they take out a loan from the life insurance company, or would they take out a loan from like a third party lender or bank?
Excellent question. So both is possible. It always depends on the product type. So we're pretending that the product type allows loan, lending, or whatsoever. So there are several possibilities then to structure it in that way. Either the insurance company can borrow some money, obviously linked then once again in this type of setup to the bank account and to the deposit account. Or, and this happens much more, or let's say much more often, is that we have a bank, for instance, who then actually provides a credit line against the underlyings in the policy. So very typically then we pledge, technically spoken, the policy towards, for instance, a bank that provides a credit line, which is something like between 50 and 60% at the maximum, depending on the underlying investments. So very obviously, let's say the more conservative your investments are, the higher the credit rate. If you, for instance, are just doing high speculation, which in some jurisdictions, this type of product allows you, let's say, without having negative tax consequences, to have a very high and aggressive strategy within your asset allocation. Obviously, a third-party lender would not be that generous in providing a credit because they just simply need the whole covered in case of urgency. So if we have to materialize as a bank, for instance, the sale of whatsoever underlying bonds or equities or whatsoever, they just want to make sure that at least the credit generated is covered by realizing the selling of the underlying. So the higher the risk within the policy, the lower the credit line you would obtain.
Right, exactly. Because if you had, for example, $100,000 invested into risky stocks, like stocks and tech companies, and the bank gives you a loan for, like, let's just say $60,000, 60%, and then those stocks drop, which is very possible. Stocks could drop half in value in one day. Now the bank is at a loss now because the money they've given you is greater than the worth of the assets at that time. Whereas if the assets are like real estate or more like conservative, like bonds, then they could probably give you a little bit more liquidity, probably greater than 60%, because it's highly unlikely that the asset values are going to drop below 60% in value based off of historical performance.
Absolutely. Yeah, you got it perfectly. And to be even more sensitive on the matter is, and sometimes you have investments that do not follow a flow. You can have overnight, let's say, a fall of X percentages. Yeah. Let's take cryptocurrency. Yes. Overnight, loss of 20%. Or let's even go further, investment into Madoff funds in the past, which actually hit zero overnight. So as soon as you are not diversified in the underlyings, the risk of the lender is just simply, if there is not a slow evolution on the performance or on the value, then you just more or less lose it all. And therefore, lending is a very, very interesting and important topic, but it has to be really undertaken with professionals involved there, because it is a major risk to be considered.
Right. And Daniel, my next question was going to be, what are the advantages, benefits of PPLI? But I think you've already answered that, right? The privacy, the asset protection, the taxes, the estate planning, the liquidity. Any other benefits or advantages of one using PPLI?
I would like to point out just one element that you didn't mention, Sari, and this is portability.
Gotcha.
Portability with international clients is a very huge asset, because they tend to, let's say, move along, go along with, let's say, either their company or, let's say, be a key staff employed with a company, or just enjoying life and moving from one place to the other. So PPLI is a very efficient instrument to actually move along physically and have the policy following you with all the benefits that it does content. So you always have to make sure that wherever you are and wherever you intend to go, the policy setup is actually made for this situation. And that is why professional advisors are needed in order to advise you correctly. And let me just give you an example as a thought. Let's take a UK resident who says, I am moving to the US. So he has two completely different jurisdictions to be looked at. It is the UK as a starting point, and it is the US. And who knows, he might go back to the UK after, let's say, building up a company, a branch or whatsoever in the US. He might go back to the UK. So this is a very important point where we call it a dual compliant policy, where we have to make sure that the legal requirements and the applicable law of every concerned jurisdiction is matched in order to make the policy full compliant. And this very typically the client does not think about. So here we need his professional environment. Here, professional brokers, as we are, kick in order to advise, assist the client and his professional surrounding with the plans that he has for the future. Just simply go out and do things can leave him with a, let's say, quite considerable, for instance, tax event that kicks in, which he has not considered while he has not been organizing the change or the moving of his current situation. So this is one of the key elements. Whatever you have in mind, share with your professionals in order to advise the clients correctly.
And which countries do you help clients in?
So we are currently working in over 30 licensed countries. We have more than 50 tax compliant solutions. And here we are mainly talking about countries with a history in the life insurance world. So typically further to the US, we're talking about the European Union, for instance, but we are also talking about Asia and other countries around the world, whereas typically a life insurance policy has, according to law, applicable parameters that have to be fulfilled in order to make the product tax compliant. So to give you an example, in many jurisdictions, if the client himself interferes with the investment rules, he, for instance, tells the asset manager or the banker to sell or to buy this or that asset, to please execute this. So we have a situation where most probably the, let's say, correct setup life insurance policy will not comply with local law. Why? Because he simply interfered and he did not leave the duty of execution to the professional setup, which in this case would be the asset manager. So to make a product compliant, as I said, in 50 countries, we also need applicable rules that are fulfilled. And this is, let's say, training and education just to make sure that we do not trigger taxable events because, for instance, clients are used to give instructions to buy and sell, and therefore we have to clearly set up a situation whereas we protect motivated clients from, let's say, interfering from a negative taxation point of view, just to give you one example where things can go wrong.
Yeah, it sounds like there's a mindset shift when applying this kind of strategy.
Yes, this is the case, but there are different types of clients and there are also different jurisdictions. So I would, for instance, like to compare a German client with a Swedish client.
Yes.
So they are both living in Europe, not far away, one country from the other. Whereas in Germany, if you interfere in your strategy, then clearly you have negative tax effects. So it is clearly prohibited by law to interfere as a client in Germany. Whereas in Sweden, we call it so-called self-directed. The law, or let's say the regulator, actually likes it when the client interferes in his own investment. So that means he knows what's going on. That means he is under the control of the investment, and there are no negative tax consequences on the Swedish client interfering within his PPLI. So this makes it so important that we have local knowledge combined with professionals, with the setup. And therefore, as I said beforehand, the client might move from one country to the other. So there are new rules that may apply. We have to know them. And therefore, very important, these key elements, to always have them working as they should.
And Daniel, do you see private placement life insurance becoming more popular around the world amongst wealthy individuals and businesses?
Yes, absolutely. I mean, yes and no. So PPLI, there are markets with a very long history. Let's talk about the US. Let's talk about Europe. Doing it correctly, structuring it correctly has always been an issue. But not all the clients know about it. So this is a learning effect.
Yes.
Whereas in certain countries, let's say France as an example, everybody has a life insurance policy. And then there are other jurisdictions, let's talk about Asia, where this is an evolution. We're not quite there yet. So we have to do a lot of training, train the market. We have to do a lot of education on that side in order to make the benefits of this product match as ever possible. But nonetheless, there is one downside to it. As a lawyer, I have to point out is regulation. This crazy increasing amount of formalities and regulation, which very often is actually driven by consumer protection, which is gorgeous. I mean, perfect. But very often all these formalities are not really to the benefit of the client. Who pays for this extra work? What is this, let's say, extra administrative effort for, let's say, positive outcome for the client? There are not many elements where we can really say all these increasing regulation are to the benefit of the client. I would even go as far as to provoke a bit and to say the product has huge benefits. It is a very efficient type of structuring, but you have to be able to master all the administrative obstacles going along, and there will be more as the future will show us. So yes, huge benefits, but watch out that you really have a good professional environment that can master all these challenges.
And how can listeners learn more about you and your organization and PPLI?
So yes, please reach out to us if you have any questions that triggered your attention. So we can be easily found WHYVP on their website, or also 1291 group if you have insurance broker questions. So please feel free, reach out to us, and very open to enter into exchanges.
Daniel, thank you so much for joining us. It was a pleasure interviewing you and getting to know you. I'm looking forward to having you back on the show as a guest speaker again.
Thanks a lot, Sari. It was a good pleasure.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.